started today. I wanted to thank everybody for joining us today. My name is Misty Garza. I am one of the financial advisors here at Bogart Wealth. So welcome to our webinar this morning titled, Are You Ready to Retire? Just a little bit of information for today. I do have the chat box open. So if anybody has any questions, please feel free to enter in questions, comments in the chat box, and I will try to monitor that through the presentation and answer any questions along the way. So for those of you who might be new to our firm, our mission is to help clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. So a little background on us, we have about $2.7 billion in assets under management, about 1,348 households. We are a registered investment advisor. And so what that means is that we're an independent fiduciary advisor that is here to work in your best interest. We custody all of our assets at Charles Schwab for your protection, and we are a fee-only wealth management firm. We have 3 locations. So we have our McLean, Virginia, which is where our corporate office is, and we have the Houston office here in Memorial City and our Hughes Landing location there in the Woodlands. So we do produce a number of educational webinars throughout the year. And so I'd like to just kind of highlight a few future ones that you can find on our website, bogartwealth.com. We do also have recorded versions as well as previous webinars as well. We have our podcasts that are listed on our website as well that can give you a link to our YouTube series as well. So for those of you who work with us, you know that planning is really the heart of what we do. And so most people think that planning for retirement is just about the investment management piece of it. So we're going to talk a little bit about are you ready to retire? Kind of what does that mean? And some of the different pieces that go into deciding whether or not you are ready to retire. And so everybody has different things that are important to them. So it's still important for us to make sure that we do a comprehensive plan so that we can really get a feel for what you and your family are working towards. So I would encourage you, if you're new to Bogart, reach out to us and we can walk you through completing a financial plan for you. Or if you have an advisor, reach out to your advisor and just make sure that you've talked about the specifics that you and your family are working towards. So now let's get started. So a little bit about the agenda today. So let's talk a little bit about what we're going to focus on. So we'll talk a little bit about why a plan is important for retirement, understanding some of the risks that people face in retirement, a little bit about the income planning process that goes into that, what the retirement analysis should include and look at. And then once you've completed that, looking at how does the investment strategy fit into that, as well as the withdrawal strategy. And then, of course, it's important to make sure that you review and monitor your progress for changes. And then the last piece is just kind of dealing with emotions as well and how that plays into planning for your retirement. So typically your choices are to retire or not to retire, but there's lots of variables to consider. So we recommend that you consult with the financial planner and work with the professional to create that comprehensive, objective financial plan for you. And a plan can be built with realistic assumptions, along with what-if scenarios that are specific to you. There is no one-size-fits-all to this plan. What worked for your neighbor or worked for a colleague at work or somebody in your family, very different than what it is that you and your family are working on and the emotions that play into it for you too. So going through the process will help you make the right decisions. And so when we look at that, one of the critical pieces is looking at your cash flow, regardless of your stage of life. So we want to be realistic with what your cash flow is. You'll probably not spend less in retirement than you spend now. One of the biggest misconceptions, I think, is that people think that going into retirement, they're going to require less income. Now, maybe if you're working and you're only spending about half of your income, then that's what we're going to be looking at. But the idea is that whatever your lifestyle is today, your lifestyle is pretty going to be that same level or maybe a little bit more initially. So it's very important to be realistic with that. And then looking at your investment strategy, very important. It needs to be aligned with your overall risk tolerance because you don't want to add additional stress in your life. And then taking into account what your withdrawal strategies are. There's very varying different strategies that would work for what your current lifestyle looks like, what your needs are, what your risk tolerance is. Again, what's important to you can play into the types of withdrawal strategies that would work best for you. And then again, you want to make sure that it's sustainable. So we want to have a contingency plan for any kind of unexpected expenses. And then we also want to review and monitor your plan, because we do know that going into retirement, we might think we have all the answers, or we might realize that we don't have all of the answers in retirement. So it's very important to make sure that we are able to have your plan be flexible, and that we make sure that we review and monitor it and make adjustments as needed. So first of all, why should you do a comprehensive plan? The first is to plan for the unknown. Again, there's lots of risks that you will experience during your retired years. And so we want to plan for those and kind of minimize all of those risks. Again, we want to make sure that you make informed decisions about your retirement. We want you to start off in the right direction. A lot of people will come to us and say, can I retire? And so that's, for some people, they're not sure. And so one of the things to look at is to say, if I'm choosing to retire, I want to make sure that I understand if I am prepared and what that retirement looks like. So we want to make a very informed educational decision on retiring. The next part is cash flow. So cash flow is crucial, obviously, because we really want to take a look at what your expenses are and all of the different income sources that you may or may not have in retirement. So part of how you do all this is creating that cash flow. And that is very important to make sure that you don't run out of money through your retirement. And so doing this plan is not a one-time event. Life happens. Your plan, again, like I said, needs to be flexible and needs to be able to move as you move through the different stages of retirement, and update it as life circumstances might impact what your goals were. So there's a number of items to consider when you're looking at creating your plan. Again, like I said, there's no one size fits all. And so part of our job is to really talk you through and figure out what that vision of retirement is for you. So we've highlighted a few things for you to think about. This is by no means a comprehensive list, but these are some of the things that we see and some of the items that we talk with people as they're creating that vision of the future. So the first one is your family. How do your decisions impact those that depend on you? Do you need to consider a spouse, children, parents? What does that look like for you? On the health side of it, think about your physical as well as your mental health. They both play a huge part in a successful retirement. How does your health affect your spouse or those that are dependent upon you? And then also looking at the physical as well as the emotional side of that. Home. Where do you plan on living in retirement? A lot of people will either choose to stay where they're at and have their home base there. Some will move closer to children or to their parents. Some will have a vision of what their retirement home looks like. So really kind of planning on, where are you going to be in retirement? Are you downsizing? Are you going to purchase a second home? And again, sometimes this is one of those big decisions where people don't really know where they're going to be. So again, when people are looking at making these big life events, choices in their life, kind of establishing that home base is one of the bigger ones. And I always caution people that if you're not really certain where you want to live, think about when you vacation. When you go somewhere, you think, oh, this is a great place. I could live here. But when you vacation there for a week or two, it's very different than living there full time. So a lot of times it's kind of making sure that we make really good decisions on where do we plan on ultimately being for our home base. Next one is lifestyle. What do you like to do? When every day is a Saturday, what are we going to be doing in retirement? Is it travel? Is it other hobbies? Is it hobbies that are free and inexpensive, or hobbies that are very expensive? So again, it can be a very big transition for a lot of people when they don't know how to fill their day. So it's very important to find out what is it that you get the most satisfaction in retirement. So for some people, that could involve going back to work and doing some level of part-time work, doing what they had already done, or it might be something that they really enjoy, that it is a passion of theirs. So it's not trying to recreate 100% of their previous income, but something that is very fulfilling and just adds a little bit of extra income during retirement. Another one is the legacy. This is very important when we are working with individuals and the planning process to find out what's the goal of at age 100. Are we planning on leaving money to our children? Are we leaving it to a charity? Are we going to spend it all? What does that look like for you? And that allows us to help make investment decisions, withdrawal decisions along the way in order to achieve that goal. And the last one is, your mind and spirit. Again, kind of what makes you happy. A lot of times people go into retirement and 6 months later, they're already bored, right? They got their honey-do list done and they don't have anything else to do. There's nothing fulfilling. And so it's very important to make sure that when your job is ending, that we really have those conversations about what's important about retirement, what's going to be the most fulfilling, what are you looking to do from there. As we look at different concerns that people have in retirement, one of the things that we find is that pre-retirement and then post-retirement, some of our concerns and our fears change a little bit as we've kind of actually gone into retirement. Obviously, one of the noticeable changes here is pre-retirement, people are very fearful of outliving their savings and investments. And I think once you've gone through the planning process and you've created a plan and you're continuing to work with an individual and created strategies that work for you, it really starts to reduce that fear. Now, I would say that if you don't have a plan, this is probably not going to look like that. But that's what the idea of a plan will do, is it'll help reduce those fears and make sure that you're successful going through retirement. You'll see a few other ones here. Social Security, not as big of a difference. Declining health, that is once you're in retirement, we do see a little bit of that going down. I think that the fear of I want to retire before my health starts to decline, you're already there. Usually people's bucket list is those first 5 to 10 years. We call those the go-go years, where people are doing lots of things while they're still young and that they're still able to do that as well. And then we also see, long-term care costs, losing your independence, see some health issues kind of starting to come into play here. So again, as we address those fears prior to retirement, we will continue to address those fears and what that means to your plan while you're in retirement as well. So a few things when we talk about the risks in retirement, and this is not going to be all of the risks that are there, but these are, I would say, the 4 biggest risks that people have. The first one is longevity, outliving your money. One of the things that is important to realize is that when you're planning for retirement, there's a few things that we will bring in when we're looking at longevity. So most people are obviously living longer with the advancement in medicine and all of that. Now, the quality of life is different, but we still have to be able to make sure that you don't outlive your money. So if we look at the numbers today, an average couple age 65, there's a 42% chance that one of them is going to live to age 90, and a 16% chance one will live to 95. So this is very important when we're doing the analysis. We are not making sure that you're going to have money until you're 80 or 85, right? It's very important, the decisions that we make, that we do plan for longevity. Second one is inflation. We all know this number, it's obviously all over the headlines with the news and what is inflation, and we've all felt the rising costs. So it's a very big risk in retirement. We make sure that we address that in different ways within the plan. Market performance, of course, depending on what your investments are doing. Now, this one obviously is out of our control, but there are certain investments that we can choose to make sure that we take on the appropriate level of risk based upon what the market is doing and how that can impact your portfolio. And then the last biggest risk is healthcare costs. Some people might have long-term care insurance. Some people might be able to self-fund that. But this is something that, as we're evaluating your retirement plan, kind of bringing in what those healthcare costs look like through retirement, as well as if there is some long-term care needs for yourself or for your parents or something like that as well. Some numbers just show that a couple age 65 will spend about $315,000 in retirement to cover their health care. So, that is typically going to be one of the bigger expenses that people are going to have in retirement. So again, kind of going over some of these risks, that the biggest risk in retirement is going to be spending. And that is the one that we can control, right? Now, when I run financial plans for people, people say, can I retire? And the answer is most likely everybody can retire. It's just whether or not it's the lifestyle that you want to have in retirement. That's the bigger question. And this is where it's really important to kind of go over what your lifestyle is. And so typically, I like to break it down into two categories: your essential expenses and your discretionary expenses. So those essential expenses are the things you need to do to keep a roof over your head and the lights on, right? So some of those basic needs, so that if something were to come up, we know that we need to cover those costs. All of the discretionary expenses, which is more of that lifestyle that we talk about and what we're going to do in retirement. And do we like to eat out? Do we cook at home? Do we travel? What are my hobbies? Is really looking at what are those wants that I want. And those are typically going to be the ones that we can control the most, that we are really having to watch. Okay. And that's why it's important to find out what your lifestyle is, because what you're spending today and those hobbies and habits that you have are going to carry forward there. Another one is looking at how much should we set aside for emergencies or unexpected expenses. A lot of this is really based upon kind of managing some market risk and what your overall portfolio looks like, so that if we did have an unexpected emergency, how does that impact our overall plan? Lastly is, how do you increase your income annually for cost of living adjustments? This is something that we talk about within the plan. And this has been very real over the last couple of years as people have had higher medical costs, have had higher taxes and insurance, things of that nature, that maybe it's not so much their normal spend that they've seen go up, but some of those bigger annual expenses. And how do we incorporate that into the plan? So this is part of what we can control. And that is very important to make sure we don't overspend and that we create a realistic budget to put into the plan and we update it. This is probably going to be the one biggest piece that when you're reviewing and monitoring your plan, this is what's going to see the biggest changes. Because sometimes people will have a really good handle on what they want to spend in retirement, and then they go into retirement and things will change drastically, whether they start to spend a little bit more, they're excited, again, they're younger, they're wanting to travel a little bit more, or whatever those look like. And so this would be the one component that we really do just kind of have to track. This just shows you a little bit about how your spending starts to decline a little bit. It does not substantially decline as you get older, like some people think. Now, obviously, you can see that the healthcare cost is the one expense typically that is always going to go up. Everything else, as we start to age, will start to slow down just a little bit, but the overall change is very small because other things start to come into play there. So again, when you're thinking about going through that retirement income planning process for us, the main part that we start to focus on is that initial retirement analysis. I would call this a kind of our base case when we're setting up a retirement plan. This is where we're at today. So whether or not we are already going into retirement in the next year, we're in retirement, or we're 10 years in. We start out with that initial base case when we're working with our clients. And then once we've kind of established where they're at and what their goals are, then we'll focus on the investment strategy, what that means for them, talk about the withdrawal strategy, meaning how do you live? How do you recreate your paycheck to pay the bills? And then again, continuing to monitor it. So this is always going to be an ever-moving process as you go through retirement. So when we think about that retirement analysis, the first step really is analyzing where you're at today. Okay, so we're going to look at identifying your sources of income and when do we need that income? Are we retiring in the next 3 to 5 years? Are we retiring this year? Are we retiring next year? What does that look like? And how does our income needs change over retirement? So again, we talked a little bit about kind of looking at those expenses, your essential expenses, your discretionary, and planning for any unexpected expenses. Most of the time when you're working with an advisor or you're working with myself, we can kind of get a really good feel for if you've never really put a budget together and you're putting one together for the very first time with going through this process. it can be kind of overwhelming to kind of track what those expenses are. So I think it's very important to work with people, and I can see if there's things that they're missing, or kind of help them build out what that looks like. It can be very detailed for some people. Other people can be a lot more what I call fluffy. They're not really sure exactly where all of their spending is going, but we can help work through those and figure out what that lifestyle is, so that this is going to be the base of the plan. And all decisions really are going to be based upon, what do you need to spend in retirement? So part of that analysis is going to account for inflation. We talked a little bit about some of the risks that we have in retirement. So we're going to build in inflation here. One of the things that you'll look at varying wealth management firms is different people will use different inflation assumptions. So something to think about if you're working with an advisor, ask them, what inflation assumptions are you using? A simple change of 1% here and there can drastically impact the overall results of your analysis. So very important to understand what they're using for inflation. We will separate out healthcare costs because those are inflating much faster than traditional inflation. So we'll build those kind of things in there. We're going to identify all of your income sources: Social Security, employer pensions, all of your assets that you have, any rental or business income, part-time employment as well. And then we'll figure out what needs to be adjusted. So again, when we think about sources of retirement income, we will look at the Social Security piece. Sometimes people don't realize the impact of Social Security. So most of the time when I'm working with retirees, obviously we're including Social Security. For most individuals, this is a 7-figure cash flow that comes in over their lifetime. So it drastically does allow them to bring in some additional income during retirement. A little bit of pensions. Pensions obviously are, not everybody has one. Only about 15% of people are covered by a pension in the private sector. So that's something that we will bring in if necessary, as also helping you decide how to take that pension, when to take that pension as well. And then, of course, we're going to look at your current savings and investments and what your investment portfolio looks like to kind of fill the gap between those two as well. So once we've developed that plan, it's really looking at, okay, the analysis will tell us yes or no, you can retire, and what that lifestyle looks like. And then it's our job as the advisor to look at it and say, okay, well, how do I do that? So creating the plan can be somewhat relatively easy, but figuring out how to pick the investments and start to live off of this is where it becomes a little more complicated, and where we have to factor in lots of different things. So first and foremost, when I'm creating an investment strategy for people, is really understanding your risk tolerance and understanding how investments can change, and how you make decisions based upon what the market is doing, or how you feel about what's going on with the market. So these are kind of 5 basic strategies that in general the market will look at. You might have some annuities that are there. This could also be part of a pension, right? A pension could be considered an annuity that's coming in. Bond ladders, we have income-oriented investments, meaning things that are dividend-paying stocks or other investments that spin off income. So business income, royalties, or rental properties, things of that nature. And then you basically have 2 different types of models that you can do when you're creating investment allocations for your 401k or other brokerage accounts. You can do what's called a fixed asset allocation, where you rebalance to a fixed percentage all the time, or you'd be more dynamic, where you're reacting to what's going on in the current market environment. So let's talk briefly about what some of these look like here. When we think of annuities, there's basically 3 types of annuities. You'll have a fixed annuity. Think of that like a bank CD, right? So you put your money in, you get a set interest rate, and there's no risk of principal. You know exactly what you're going to get for whatever that period of time is. The next one is going to be more of an index. So it's going to be a little bit of a hybrid between fixed and a little bit of market movement. First and foremost is it's going to be a guaranteed principal back. Now, whether or not you get any additional interest on top of that, it can be a percentage of the market, right? So if the market goes up, you get to participate in a little bit of that. If the market goes down, then you just get back your principal. So that's how the indexes work. And then we have a variable annuity, which will be, you put your money in, and it's going to be like an individual mutual fund, to where if the market's moving, you're going to feel the full brunt of whatever that investment type is. So again, hence the name variable. You're not going to be any guarantees with that. Bond ladder, again, some of these are very specific based upon what is appropriate given the current environment. So, very simply stated, a bond ladder is, you can create different years. The money is essentially guaranteed, whether this is a CD bond ladder that you're doing, or you could do a corporate or a treasury bond ladder. And the idea is that you put your money in and they will pay you a set amount of interest, and you kind of reinvest that principal and you live off of the income. So again, this could be for a portion of somebody's investments. It could be for all of their dollars if they're a very conservative investor. Again, very specific based upon what your risk profile is, what the current market environment looks like for something like this as well. The other piece of looking at more of the income-oriented investing, if we're specifically looking at buying dividend-paying stocks, this first chart is just the S&P 500. So just putting your money into the market, you can see that there's some volatility that you're going to have here. So you're going to feel the full brunt of what's going on with the market versus income-oriented investments. Much more of a smoother line. Companies that pay income and dividends typically are not going to be those high growth stocks, so they don't have as much volatility. So part of going into that is because we do want the income and a little bit more of stability of market valuations there. And part of that, when you look at that and say, well, this one looks much smoother, or this one has more growth, this, would be more appropriate for me. We don't know what's going to do well in any given year. I'm sure a lot of you have seen this Ibbotson chart here, where in any given year, there can be a different sector of the market that does well. There can be a different growth or value will do well. So this is why it's important to figure out what does your investment strategy look like? What are we trying to achieve? What's my risk tolerance? And kind of incorporate what all of this means to you. There's no consistency on saying, well, this has always been the number one performer, so I'm just going to go with this and never have to review or monitor that. So once we've kind of created a little bit of an investment strategy or understood some of the choices that we have, part of that comes into play is the withdrawal strategy. And so there's basically three types of withdrawal strategies that we would look at for people. So the first one is income only. And really what that means is that you put your money into an investment and you live only off of the interest and dividends. It's very popular. People like it because what it means is that you're never having to sell. And it is a way to say that I'm not going to run out of money. Now, obviously, you need to make sure that the investments that you're buying are good, solid investments. So if they're CDs and money market accounts, obviously, those have some guarantees. But if you're buying a dividend-paying stocks, you also want to make sure that those are good, solid, have a good, solid history of dividends and managing that income-only piece. But it's a great way for people to say, I never have to sell anything. No matter what happens, I have this guaranteed income stream coming in as well. Second one is going to be systematic withdrawals, which means that you have a portfolio in a certain investment mix, and you just take out what you need every month. So if somebody needs $10,000 a month, you just have it in that investment strategy, and they just sell $10,000 a month from that investment. And then the last one is more of a bucket approach, where we create specific portfolios designed to kind of meet immediate needs, intermediate and long-term goals. And again, none of these are, one is not better than the other. They all fit for different people based upon what the overall objective is at the end of life. But this is where we talk about what your risk tolerance is, what your goal is, and kind of go through some of these and create a plan based upon one of these, two of these, or maybe even all three of these. These do not have to be one or the other. So when we think about this, let's talk through a little bit of these initially here. If we look at an income-only strategy, the idea is like I said, you're living off of income only, you never touch. the principal or never have to sell anything. So if we think of this in very simple terms, if somebody needs $5,000 a month, $60,000 a year, Social Security, let's just assume they're already elected Social Security. We know that that's coming in, so we consider that, guaranteed income. We may or may not have a bond ladder, so we might have some of those with a little bit of money coming in to guarantee some additional funds. And then the rest of that would be in dividend paying stocks. Okay, so again, what that means is that, as you can see, all of this is interest that is coming off of these investments, and we've never had to touch the $1.5 million that we have invested in that account. Now, part of this, when you look at, what are some of the risks associated with this? So obviously we do need to look at your overall inflation. What does that look like? What does your spend pattern look like? What is our goal for, leaving money behind? Things of that nature. Second one is the systematic withdrawals. So remember, I said this is just where you have a bucket of money and we just sell what we need every month to cover our expenses. So again, Social Security is factored in here, and it's just a matter of putting the money into an account and selling. So this can be good or bad, depending on what kind of investment you have it in and what the market is doing as well. The last one, which is the bucket approach, I would say that this is probably for me a very favorite approach for a lot of people, because when you go into retirement, one of the biggest concerns that we saw previously is that people are fearful of running out of money. That fear doesn't go away, and the market is a very real concern for people when they're in retirement. When you're working and the market drops, you don't feel it as much because you know that you don't have to touch it, because you're going to be replacing it with continued 401k contributions and employer match, or just not needing it yet. And so people feel very comfortable with the market when it's volatile while they're working. But once they get into retirement, they feel very differently about how the market is reacting. And we'll talk a little bit about emotions on the back end. So this bucket approach really kind of helps balance out those emotions. So remember when we talked about it, it's about setting aside immediate, intermediate, and long-term type of needs. So let's just say, again, same $1.5 million, you need $60,000 a year. We have Social Security, that's part of that. And we have a bucket one. So the idea is we'll look at the first, years 1 through 5 and say, okay, I need $300,000. So typically with those, I'm going to have things that are either going to be guaranteed or very little volatility with the market. They're going to be very safe and secure for a lot of individuals. Now, does it have to be 5 years? No. Again, part of this can be based upon how big is that number? What do we have going on? And what's their risk tolerance as well? So some people might look at that and say, you know what, I only need 3 years worth of income, or I want bucket 2 to be a little bit bigger or a little bit smaller. So again, we can kind of tailor what this bucket approach looks like. But the idea is that the money that we're sending you in those first couple of years, there's no risk with that. And so you still need the money, the market's doing what it's doing, and you're not having to sell it all. Because one of the things that we do know is that the market will recover. We just have to be able to stay in it to be able to recover. So the idea is that we're not touching any market money. That second bucket, the bucket 2, again, like I said, could be any length of time. It's typically going to be 5 to 7 years for most people when we think about how big that bucket's going to be. And those are going to be investments that are going to be a little more moderate. Okay. And again, can be very specific for each individual's risk tolerance. A definition of moderate for one person can be very different than what that looks like for somebody else. But again, bucket 2 is not going to be 100% growth oriented, meaning it's not going to be feeling full ups and downs of whatever's going on in the market, right? So we're going to give that a little bit more of a conservative nature to it. And then bucket 3 is going to be, for some people, 10 plus years. In this instance, we have it at 13 plus years. So it's going to be money that we don't plan on touching for 10 years at least. And so we can withstand the ups and downs of the market. Now, does that mean we're 100% in the market? No, right? Some people don't need to be. Some people do need to be to achieve their goals. So again, that's going to be that level of growth will be based upon what it is that you're working on and what your comfort level is. But the idea is that if we give bucket 3 the most market exposure and the most years to recover, then it will be there and it will be our hedge against inflation. And as we're working through this, we don't necessarily finish bucket one and then just start to move to bucket two. As we're going through these years of retirement, we can start to fill these buckets, right? So the idea potentially might be that we might want to have consistently 5 years in bucket one. So if we've gone through the first year of retirement and now we only have 4 years left, we can look at it and say, okay, what does the market look like? How do I feel about everything? And do I want to replace this, that I maintain those 5 years worth of guaranteed income? And if the market's doing well, we could figure out, do we take that from bucket two or bucket three to fill that ring? Or if the market's not doing good and we need to be able to say, okay, we need things to recover, then we know that we still have 4 more years worth of money set aside, and that'll allow everything else to recover. So kind of working through this again kind of alleviates a lot of the market fear in selling when the market is down. So when we think about how we're creating all of that and what our goals are, one of the ideas is people want to know how long your money is going to last. And so depending on when you start using your money and what your rate of return is in inflation, that has an impact on how long your portfolio will last. So for a lot of people, you hear the 4% number. That's just kind of the number that floats out there all the time when you'll read about something on the investment news or people retirement planning. So 4% withdrawal rate is safe for a 60-year-old individual. It means that it'll last them for 40 years. Now, what that does mean is that you are going to be at zero. A lot of people will have the misconception that if I have a 4% withdrawal rate, I'm only living off of the interest or the returns. No, your portfolio is declining because the idea is the market is not always consistently going to be positive, and you're going to have inflation, right? So you're so slowly over time that portfolio is declining, but it does mean that for 40 years that you would have your portfolio. So the higher your withdrawal rate, obviously, the longer that money is not, going to get you to 100. So if you have a 5% withdrawal rate, it gets you to about 30 years. If you have a 6% withdrawal rate, that gets you about 25 years or so. So you can definitely see. So once the industry says you can have a 4% safe withdrawal rate, again, a lot of that's going to depend on how old you are. If I have somebody who's retiring at 70, they can obviously sustain a higher withdrawal rate. If I have somebody who's retiring at 50, then we probably need to look at that withdrawal rate as well, because they're going to have a longer period of time that they need those portfolios to last for them. So then when you think of that, one of the first questions is what if inflation is higher, right? So if they don't like that inflation number, especially in today's times. So typically when inflation is higher, investment returns are a little bit higher. So again, it's really the same, that real rate of return is just assuming that 3% over inflation, the results don't change, okay? Okay, so let's talk a little bit about kind of like how to manage distribution. So again, we've gone through creating your analysis. We've gone through your investment strategy, what that looks like. And then we talked a little bit about your withdrawal rate and how to do that. So then the next thing is to look at is where do we take all of this from, right? And so part of that is figuring out where is your money and how old are you? What are some of the tax laws that are going on, whether the current income tax brackets or required minimum distributions that might be starting for somebody who is 73 or 75? Like, what does that look like? And so part of that is figuring out, okay, what makes the most sense for you, and going through and starting to figure out which accounts are going to be the best ones to take from first. So sometimes people will say, well, let me just take everything from my brokerage account. It keeps my taxes low, right? That may or may not be a good choice, because required minimum distributions could be huge later on in life. So part of this, again, on managing these distributions is really built into that initial retirement analysis, and putting in those numbers, looking at what your cash flow needs are, what your account balances are, helps us as advisors figure out if we're trying to create $120,000, $10,000 a month in income, where do I take it from? So again, going to be very specific for each individual as well. And to that point, when you look at the tax planning piece of that, when we're figuring out where to take that from, your different buckets of income are going to have different taxation on them. So Social Security is taxed differently than your pension versus interest income, IRA, 401k distributions. any dividend income that's coming off of stock, depending on where it is, long-term capital gains, Roth, things of that nature. So that's one of the things that's important to look at from a federal income tax standpoint, as well as a state income tax, right? As we move maybe to a new state in retirement, there may or may not be state income taxes. So bringing in all of that as far as where do I recreate this income, recognizing that I have to pay taxes today, but I also have to pay them in the future. So what is the proper planning tool so that I am not surprised? So again, part of all of that is looking at, once we've kind of established that and we're going through retirement, then it's a matter of reviewing and monitoring that. Again, like I said, once we're creating a plan, it is not, we create it today and this is the plan we have to follow for the next 30 or 40 years or however long we're going to be in retirement. So it's very important to make sure that we continue to look at a few different things in that plan and refresh those plans. For a lot of our clients, we will maybe do a refresh once a year if need be. Maybe nothing has changed. And so, we might go 2 or 3 years or something like that. Again, very specific on their situation, but at least I've created a base plan so that if I look at their plan and we did a plan last year, I can pull up their analysis today and say, you know what, by the end of this year, our account balance are supposed to be X. Okay. And so that's where we look at that. Are your assets higher or lower than projected? So if I know I'm supposed to have $5 million by the end of this year and I'm sitting at 4, right? Then my question is why, right? And so all of these kind of things play into that. Or if I'm sitting at 6, why is that? And so part of that is when I look at what we're projected to be, if we're ahead or behind, I'm going to look at the income. Did we estimate the income correctly? Meaning maybe did we turn on Social Security earlier, or we thought we were and we didn't, or we sold a business, or we had some additional income come in, or income didn't come in that we thought was. So making sure that we planned appropriately for that. And then look at the spending. Did we spend more or less than what we had really thought? And if we spent more initially, then looking to say, okay, is that a one-off? Or is that going to be, maybe we truly didn't have what our lifestyle was. And so maybe we need to make some adjustments on the projections to say, okay, I was a little off. So let's figure out what that true expense number looks like of what I'm going to do in retirement. Looking at the portfolio as well, did the market, was it a pure market, return issue? Did we spend what we thought we were? All of our, everything kind of checked the box. There was nothing out of the ordinary, but the market either performed better or worse, right? So figuring out what does that look like and do we need to make any adjustments if that happens? Again, part of the withdrawal rate kind of coincides with the spending, right? And looking to see if any of these changes happen, does that still keep our withdrawal rate within a sustainable range that we want to make sure we have? Inflation. So, was purely spending just due to inflation? And I can tell you what I typically find for a lot of people is that, again, because the plans are always going to build in inflation, one of the things typically that I find is that once every January 1st rolls around, the plan is going to assume that your expenses have increased from the previous year. And so it's always going to be consistently increasing on that base expense number. But in reality, it doesn't work that way. Every January 1st, clients don't call and say, hey, Misty, I need to get my cost of living adjustment on my portfolio, right? The $10,000 you were sending me, I needed to be $11,000 or whatever number it was that we had agreed upon. Most of the time what happens is we kind of absorb that a little bit. And then at some point, a couple of years later, we start to say, you know what, it's not going as far as it was. Now I need to do that. So when we think of the plan, I look at the plan kind of has a little bit of extra hedge against inflation kind of built in, because the reality of how we as individuals that inflation impacts us, it really doesn't impact exactly the way the plan is doing that. And this has been a huge test over the last 5 years or so on, are we truly increasing our expenses every year? And the reality has been no. Really only in the last year and a half or so have people said, you know what, I think I need a little bit more, or they're going to plan their trip and their trip is costing just a little bit more. So that's part of how we'll look at it and see how has that impacted. Does that have any impact on what our analysis shows? And then, of course, your retirement goals and expectations, have they changed, right? Do we just need to do a complete refresh because what we thought we were going to do, and now we're heading down a whole nother path as well? So again, part of that, a little bit more in detail when we're looking at that, and once we've addressed whether or not we are on track, is looking at those spending. Do we need to make any adjustments to that? The withdrawal strategies, evaluating what we did last year. Is that still the right way? Like, do you still feel comfortable doing that? Does the market still show that that is the best strategy as well too? And along with that, looking at those individual investments and saying, do you still feel the same as you did last year? Has something changed in the market or in your comfort level to say, you know what, I think we need to reevaluate those investments? And then the last part is, just rebalancing. Has there been a shift in the market to where we think that there are better options for you to achieve those goals as well too? The last piece of all of this is that risk tolerance piece. That's really the emotional piece of it. And so this is the piece that can destroy your plan. And so when I talk about risk tolerance, when I do an analysis, I can look at it with no emotions attached and say, this is the rate of return that you need based upon, whatever the success is of your portfolio that you want to achieve. But the reality is that people may or may not be comfortable with what it'll take to get to that number. And so part of that is that emotional part of it. So when we look at risk tolerance, there is just the financial number that says this is what you need to be successful. But then there's also the emotional and the behavioral piece of it. Okay. That is very important, especially given all of the things that have happened in the market over the last 20 plus years. So this is just kind of a little thing that shows you a little bit depending on where you get in to the market. So let's assume that you get into the market when the market's doing well, right? You're happy, right? You retired, you put your money in, you're feeling really good about what happens with your investments. Market starts to take a little bit of a dip, right? You've never experienced that before. Maybe this is the early part of retirement. And so now you're getting a little nervous potentially, right? And so then we're kind of having those discussions of, oh my gosh, what happens if this just goes to zero, and kind of managing that. So the part of this is more of that emotional piece of your peace of mind. There's the behavioral part of this, right? That can be triggered at any point along this that would say at some point when it has turned, you don't want to face these emotions anymore, right? And so that behavioral piece is the one that can then impact what our overall success of our portfolio is and cause us to make investment decisions and changes that are probably not at the best time of the market. So the idea is kind of managing this because the market is going to be up and down, and there's always going to be a reason to sell, right? So when you think about all of the things that are going on, I know that as I've been doing this for over 25 years, people will say, well, this time is different, right? Every time is different, right? You look back and there's always going to be a reason why I shouldn't be investing in the market or I should get out. Right. And obviously, this isn't even updated with all of the stuff that's happened more recently with everything. So it's important to kind of understand and kind of manage when events like this happen. Emotionally, how are you going to feel about it? Right. And I need the answer to be, I'm not going to do anything about it. Right. And so what that means is that if your portfolio drops a certain level based upon what we've decided, I need people to say, I'm going to be okay with that. Meaning I'm not going to sell. That behavioral piece is not going to kick in and cause me to walk away from the market and get out of the market, because we all know that the market recovers. We just need to be able to get through that cycle, right? So this kind of will show you a little bit about some of these emotions during a recession, kind of that same fear and emotional roller coaster that we showed you earlier, right? Again, you kind of go through, I'm happy I invested when I did. You're feeling really good about the decisions that you make. Then the market starts to come down and you're like, okay, not really sure. I don't think this is as bad, but I know the recovery is coming. And then there becomes a point to where you're like, I can't take this anymore, right? This is that behavioral piece that'll suddenly click in and say, I'm done. And you either choose to go to cash or you make other investment decisions that you shouldn't be making. And then you kind of feel like, well, see, the market continued to go down. I'm glad I got out, right? But the idea is like we said, the market will always recover. We just need to be able to stay in long enough to be able to get to that recovery. Because what happens is this recovery happens very fast. And we have to have two right answers if we're going to sell out. One is knowing when to get out, which is somewhat a little bit easier, right? You can look at this and say, you know what, things don't look so good. The numbers don't really justify that the market's doing good. But the problem is you would have needed to know that this was the point to get back in, right? So if you got out here and you got in here, then you got all of the recovery. The problem is this is typically the worst of times, and you're saying, whoa, man, I'm glad I missed out on all of that. You would never want to get back in at that point. Nobody feels comfortable doing that. And the rally happens very quickly and before we even know it, right? So we don't even know that there's a rally until we get back up to over here and we've missed out. We sold out here and we're trying to get back in here, right? And then we kind of run and say, well, I think this is it, right? So we have to kind of manage that. And part of this managing the emotions is when we look at those investment strategies and withdrawal strategies, a lot of those will help alleviate any type of emotional risk tolerance that somebody feels that they have. Okay. So that's how, when I talk to clients about creating those strategies, we're going to have a lot of conversations about, well, what did you do in 2008? What did you do in 2020? What did you do in whatever year it was? So that I can kind of assess that comfort level with risk. So again, kind of, going into this is just, that emotions, right? The fear and greed is, buying high, selling low. Like that's just naturally what we end up doing. So if we can create a portfolio that can help protect all of those things, but specifically for you, that'll withstand all of those volatile markets and help you understand that you're not going to run out of money and you're still going to be able to have your monthly income that you need, and we don't need to make any adjustments, then hopefully we can stay true to our plan and not have to make any risk tolerance changes to that plan. So with all of that being said, the bottom line is to have a plan so that you know what level of return you need to be successful and you know all of the potential unexpected things that may or may not happen to you in retirement. So when we think about being ready to retire, some of the things to kind of think about is think about what your retirement is going to look like. When every day is a Saturday, what are we going to be doing? What is most important to you and to your family there? Again, understanding the risks, looking at the longevity, the inflation, market performance, any healthcare costs. A lot of that is our job as advisors to talk to you about those kind of things and when building in that plan to address those. And some people might put more emphasis on other ones, again, depending on what's most important to you. So putting all those together, creating that plan to address all of those things, but you can go into retirement feeling very comfortable and confident with the next steps of going in there. And then again, reviewing and monitoring that as things change, your goals change. If you need to pivot a certain direction, then we want to make sure your plan is flexible and can do that. And we don't want your emotions to derail your plan. So the idea is that if we have a plan and we know what the success of our plan looks like, hopefully that can give us the confidence to not let our emotions cause us to make any decisions that we know we shouldn't be doing. So when you think about working with an advisor, what are some of the things that you should look at, right? Obviously, we're all certified financial planners, so you want somebody who addresses all the different areas of a financial plan. They know your plan. They know the IRS rules. When you think about the impact of the decisions that you're making, has navigated multiple business cycles to understand what's going on in the current environment, whatever it might look like, as also manages those portfolios so that they understand how to tailor those as well. You want somebody that's going to show you the various strategies. So one of the things that I think is important is that when I'm creating an analysis for somebody is as I've learned about what their goals are, I'm going to show them all of the different strategies that are out there. And then I'm going to say, this is the one I think fits the best for you. I don't want it to be that this is the only option. No, I want you to feel comfortable with that you've explored everything so that the decision that you make, you feel very comfortable doing that. And again, somebody who has the financial planning based upon your needs and your risk tolerance and does those regular updates to be able to review the portfolio as well. And also you want somebody who I think that you can say, speaks in a way that you can understand. I have some clients who want to get into the weeds of everything. And so we'll dive really deep into some of these type of subjects. And then other clients are kind of like, I just want the Cliff Notes version. I'm not really interested in this piece of it, but I want to feel comfortable with it. So we make sure that we know what's going on, but we're not trying to understand every single piece about it. So it's important to let your advisor know what kind of person you are and what level of detail, what level of knowledge do you want to have within your financial plan. And so one of the things that we will do here with our clients that we work with is one-on-one, right? Again, like we said, this is very much tailored to you. So we definitely want to make sure that we sit down and talk about what your specific needs are and how we can help you do that as well. So one of the things that you can do is if you wanted to sit down with one of us, if you haven't already worked with us, or if you haven't done a full financial plan with us, we would love to be able to do one of those with you and work through some of those things. So on our website, we have lots of different ways to contact us. So you can go to bogartwealth.com. There's a toll-free number, all of the different offices that are there as well too. So if you would like to reach out to one of us, then be more than happy to arrange a time to be able to do that. So I would like to thank everybody for joining today and remind you that we have lots of different resources that are on our website that you have access to. So this video will be posted within a couple of days or so on our website. Lots of other videos that can be very topical based upon what you are working on or your family might be working on. We're on LinkedIn, we're on Instagram, we're on YouTube, lots of different things. We also have a podcast as well that you can find for different topics. And so I will leave it at that. If there are any questions, I will open it up for any questions. And I'm more than happy to assist you guys with anything that you may need. Give it a couple of minutes to see if any questions come in. Otherwise, I hope everybody enjoyed the webinar, and please look for any other up and coming seminars as well.